and we are going to start now. Hello, everyone. This is Poonam Sagar at Indoindians.com. And today we have a very interesting session, which is stock trading basics and how not to lose money. And our expert speaker today is Kavita Rai. Kavita Rai is holds an honors degree in accounts from the Calcutta University and a level 2 certification in capital markets from the Stock Market Institute, Bangalore. With 30 years of experience running her business, Kavita now oversees the company's statutory, legal, and accounting matters in the design and fabrication of pressure vessels and blowers. She also possesses a deep understanding of taxation. 4 years ago, she completed a certificate course in capital markets and has since been actively involved in the stock market, providing investment management and financial planning services to her clients. Kavita has recently moved to Jakarta and she has stepped up. Thank you, Kavita. It has been a pleasure, that you have, sharing your knowledge here. And we are looking forward to hearing all about stock market investing in India. Thank you.
Thank you. Thank you, Poonam. Thank you for the introduction. And yes, now that my husband is in the transferable job, I had to do something remotely. So then I studied for 2 years. And this has been a great journey, a lot of learning. And in fact, I started trading only after I studied for 2 years. And it's a subject which requires skill. It is a scientific approach to it. And I'm sure all of you are going to love it. Now, the subject is too vast and basics, you can even see it through YouTube, etc., etc. What I'm trying to get to you is how you're going to understand this, how you're going to trade in a very concise manner. And you will love it. You will start trading and you will find this something very different. And as you get more and more into it, you're just going to get passionate about it and you won't be able to leave it. That is my assurance to you. So should we start?
Yes, please. Please start.
Okay, so we gather here today to learn how not to lose money or how to make money in stock trading. That is what our agenda is. So let me introduce the concept to you. To participate in the stock market, you have to be either a trader or an investor. Trading is buying and selling in a short period of time, and investing is over a longer period of time. But both require skill. And this skill, as in say, and it is a profession. Okay, so just like a doctor needs his MBBS degree and needs tools, and a technician, a chef will need the skill to cook as well as need his tools. An engineer, even a plumber, carpenter, everybody needs the technique and tools. Similarly, we have to approach stock trading in such a manner in which you have to use your technique and your tools. To apply, you have to do it in a scientific manner. And if you get into trading or investing without using tools and techniques, then what happens is then you're speculating. And speculation is what lands you up into losses. So if you learn the tools and techniques and you don't speculate, you just don't enter the trade market without knowing the tools and techniques, it is a very smart way of approaching the trade market, and you will not lose money. You will not lose. To this, I mean to say is, we will get into it. So there are three. So in this, I would ask you to take your pen and paper and start noting down. Very, 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 very concise. Just start noting down. We are going to do 3 tools and 2 techniques. That is it. 3 tools and 2 techniques. So tool number 1, what you're going to do is you are going to do trends. Trends is your first tool. Second tool is support and resistance. That's tool number 2. Third tool is candlesticks. So we have three tools. What are we going to do with these tools? We are going to analyze it on a chart. We are going to analyze three tools on a chart. Okay. Now we're going to do three tools on a chart. Excellent. Now, which chart, which stock chart am I going to do it in? Which stock is going to this be? For that, we are going to use two techniques. One is, please note it down, these are the two techniques. One is a top-down approach, and one is a momentum strategy. Two techniques, top-down approach, that is technique number one, and momentum strategy is technique number two. So you have the tools which you're going to analyze on a chart. How are you going to choose the chart? You're going to choose the chart with these two techniques. That is it. And you start trading. So we are going to start trading in a very scientific manner where you are not going to lose money. You're not going to lose money. So I'll just repeat. You have three tools. Tool number one is trends. Tool number two is support resistance. Tool number three is Japanese candlesticks. These three tools, we are going to analyze it on a chart. Chart of which stock? That stock you can identify by two techniques. And the first technique is a top-down approach. And the second technique is momentum. That's it. And you start trading. Now I've given you, this is the concept, this is the gist. This is how you're going to start trading. Now I'm going to share the screen, share my presentation, explain each and every topic in a little elaborate manner for you to get it. So I'm going to start right now. So I share my screen. So here we are, stock trading and insights for success, best trading strategies in the stock market. I just explained to you this, that these are your tools, that is your trends, support and resistance, Japanese candlesticks. These three tools, we are going to analyze it on charts. And how we're going to identify which stock we're going to do. There'll be two strategies or two techniques, top down and momentum. Two techniques, three tools. Here we begin. What is trading? Trading is an act of buying and selling instruments such as stocks, bonds, commodities, currencies with the goal of making profit. The trading is actually buying and selling of anything. It's a transaction. The element of trading here is the element of profit in it. We are entering this to make profit, whether we do it in the short term or we do it in the long term. What is stock? Stock is a type of security that represents ownership in a company. When you buy a stock in a company, you are essentially buying a small piece of that company. You're not speculating. You are a co-owner of that company. You own the company. Stockholders are also known as shareholders. Investing in stocks, why do we invest? Because you want the value of the stock to go up. That's called capital appreciation. And you get dividends if you are an owner of a company. If the company makes profit, they share their element of profit called dividend with you. There are two concepts in a stock market. We are only going to do the bull concept today. The bear concept is you need a lot of expertise for it, which going down the line, when you do an advanced course, you can definitely understand that. But initially, to invest or to trade, you need to go long. When a trader is bullish about a stock, it means they believe the stock price will rise. To take advantage of this belief, they initiate a buy order, acquiring shares of the stock at the current market price. This is called taking a long position, or you have a bullish view on the market. That means you will buy a stock. You can, if the market, now market doesn't always remain bullish. Market can be bullish, will be sideways sometimes, and can be bearish sometimes. So traders, not investors, traders do make money even in when the market is bearish. How do they do it? They don't own a stock. They enter into a contract to sell a stock. They may sell a stock at rupees 100 and book out at rupees 90, making a 10 rupees profit when they understand that the market is bearish. You can also do this as a trader because this is only available in derivatives, that is futures and options, which is an advanced course. So we are just going to take the bullish part of it, the long part of it. We are going to go long. Now, the first tool, we are approaching the first tool. Please just, you have to know the basics. You know the basics. You are a trader from day one. Just know the tools and techniques. So we are going to tool number one, which is now tool number one is trends. Market moves in trends. You have higher tops and higher bottoms indicating uptrend. You have lower tops and lower bottoms indicating a downtrend. You have a sideways market which has the same top and same bottom. These trends I'm going to explain in the following slides. So please, if I'm a little fast, I'm going to explain this in the next slide. Just keep in mind, these trends can be applied in all time zones. This is what you need to know, is this can be applied in all time zones. That means monthly, weekly, daily. Time zones, what I mean by time zones in a chart, a stock chart, means monthly, daily, weekly, hourly, minutes. These are all the trends. They work the same in all time frames in a chart. Can be applied in all classes, all asset classes. You can apply the same charts. Once you've learned the basics, you can do cryptos, you can do currencies, you can do commodities, you can do equity in all asset class. And please keep in mind, every trend comes to an end. It will not always be bullish, it will not always be bearish, and it will always not be sideways. So we will start now with the first trend, that is the upward trend. The upward trend is when the price of a stock is making a higher top and a higher bottom. That means you buy a stock at rupees 100 and the stock goes up to rupees 150. You know, the stock will not go up in like a linear straight line. It will go up, come down, go up, come down. So next, when it comes down not at the price Mr. A bought. Mr. A bought at rupees 100. It comes down only to 125. That is where Mr. B bought. That means Mr. B is buying it at a premium. You bought at rupees 100, but Mr. B is buying it at 125. Then Mr. C, then it goes up, it makes even a higher top. That is, the stock goes up to 200. Wow. Now when it falls, it comes down only to 175, doesn't fall any further before the next move. That means there is demand. And there is demand at 175. There are more buyers than there are people ready to sell. So at 175, there are more people. That means the stock that you bought at 100 now is getting a demand. People are buying at 125. When it goes up to 200, comes down, there is demand, comes down to 175. It doesn't fall further. There is a demand at 175. There people are ready to buy that stock at a premium. So higher tops and higher bottoms. When you see this higher tops and higher bottoms, which I've also explained here, that it comes down, goes up. When it comes down, it makes a higher bottom. When it goes up, makes a higher high, comes down, makes a higher bottom. That means it's an uptrend. You will buy a stock when you see the trend is upward. You will buy a stock on a chart when you see that you will draw this trend line, and you will see this you will, with practice, you will see you can do it. You will buy a stock when you see the stock is in an upward trend line. You will not buy a stock which is in a downward trend line. Somebody is suggesting you buy this stock, buy Reliance. You put Reliance on a chart and see, is it forming an upward trend line? If it is, then you will buy it. But no, don't just start buying it. You have to buy it support and resistance. We will see this further. Next is the downward trend. This is very interesting. I buy a stock at rupees 300. The stock falls at 250. Stock falls to 250. I said, oh my God, I made a wrong choice. I have bought a stock at 300 and it's fallen to 250. No, no. This cannot happen. I cannot be wrong. I will wait for the stock to go up. When the stock goes up, it doesn't, as I told you, it will not fall down in a straight line. It will be up, down, up, down. So it goes up to 275. I said, no, but I bought it at 300. No, 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 no. I will wait for it to go to 300. But it doesn't go. It falls again to 200. What the hell? It's fallen to 200. Now what should I do? No, I'm not. I'm not going to sell. I bought at 300. I will exit only at 300. Let it not go up. I'm not going to lose my capital. I'm not losing my capital. I will wait. Next, when it goes up to 225. Oh my God. First it was 300. My God, should I have exited at 275? I did not exit. I waited for it to go up, but this time it made even a lower bottom. What happens? Waiting for it to, a trader becomes a long-term investor. I will wait for the trend to change from a downtrend to a sideways trend to an uptrend. So a trader, this stock that now, which is in a downtrend, can maybe go up. The trend can change even after a year. After 2 years, you'll have to wait for it. So if you don't cut your loss at 250 rupees, you become a long-term trader. You keep waiting. That is what it is. This is a downtrend. Downtrend is where you make lower tops and lower bottoms. So don't, if your intention is to be a trader, don't become from a trader into an investor. Cut your losses. Keep your loss as minimal as 1%. That's it. That is it. And if you see that you have made a wrong decision, go on to the next stock, 1% loss, but the ratio risk to reward, which you will see as you grow, you will learn how to put a stop loss, how to do a risk to reward. So risk is just 1%, but the reward can be 3%, 5%, 10%, 15%, 100%. So don't be stupid as not to cut your loss. If you can make a mistake, to err is human. Everybody does make a mistake. Even the best of best make mistakes, okay? But cut your losses at 1% and make your profits 5%, 10%, 15%. Not to worry. You will make money in the stock market. Follow the process. Follow a process. Give a scientific approach to trading, to investing. Don't speculate. You will make losses. Now we go to the next. I hope I'm not taking too much time per slide. Now, this is a sideways market. Sideways market is in a range, means the top and the bottoms more or less are in the same range. It will go up, come down. It will not make a lower low, maybe 1 rupee, 2 rupees. It'll go up again, make a similar high, it's a sideways market. Sideways market, please note down, has two names. Name number 1 is accumulation. Name number 2 is distribution. There are 2 phases to a sideways market, accumulation and distribution. So what happens when a stock goes up? It just randomly makes higher highs, higher highs, higher highs. You see it's making a higher highs. And then you see it is slowing down. It is not making a higher high anymore. It's stuck there. Now it's just coming down. It is going up. It is coming down. It is going up, but not making a lower low and not making, it is consolidating. So after it has gone up and it consolidates, it's called distribution. After it has fallen, after the stock is fallen, it consolidates, it's called accumulation. This is basically a sideways trend, means it's preparing for the next trend. It's like a car going in speed. When it wants to change its trend, when it wants to make a U-turn or to turn, to go right, to go left, do you go in speed? No, you don't turn a right or a left in speed. What do? You slow down. That means it consolidates there. It's a sideways trend. This sideways trend is very volatile. Only very experts can trade in this trend. You can trade. You buy every up, every down. You can trade. It's not that you can't trade, but you need a lot of expertise. I would suggest as initial investors and traders, you just go in for the upward trend and the downtrend. So I'll just repeat. Accumulation is a breakout at the top of the sideways trend, suggests accumulation of a stock at lower levels by investors. Distribution, that means after it's a breakout at the top of the sideways. Okay. That means it is accumulation. And after accumulating, it breaks on the top. Then it's distribution. That is a sideways trend after the stock has run up. After the stock has done, it starts distributing at higher levels. After it's distributed, it then falls down. Distribution, conversely, a breakout at the lower end of the sideways trend indicates the distribution of a stock by investors who bought at higher levels. Understanding these patterns can help investors anticipate potential movements in the stock and make informed decisions. Now, all this you may not understand 100% in the first session. You have to do a course, you have to read books, you have to practice charts, but this is how you need to go. I'm making just simpler for you, is you will have to do 3 tools and 2 techniques and you are in. Now, tool number 2, we finished tool number 1. I've given you a brief. Now, this is tool number 2, support and resistance. Support is like a floor that stops the price from dropping further because buyers step in to purchase at this level. Every time the price goes up, comes down, it will not fall beyond a particular point where the demand is more than supply. Okay, that is support, where the demand is more than supply. It is a floor that stops the price from dropping further because buyers step in to purchase at that level. Resistance is a ceiling that stops the price from rising because sellers are more active at that price. They start selling at that level. This all you can see in your chart. Just know what the tool is, what a support resistance is, and you'll be able to see it on a chart. Support. It is a floor where buyers step in, creating a demand to stop a price and increasing it. Traders watch these levels to find good times to buy. When I was given trading, we were told to get a printout of a couple of charts. Then we were told to take a ruler and pencil and identify on the chart, look at the prices from where his history repeats itself. That's Dow theory also, that at which price can you see in different time zones that the price is again going up. After it has fallen, it is again taking support. So we used to take a ruler, take a chart, put the ruler on the chart and plot the points at which the price is taking support. So look for a price here. Look, see, the price is falling. The price has gone up. It has fallen. It has taken support here. This is a chart. The price is going up again fallen, taking support. You have to plot these points on a chart. Plot these points on a chart. You'll be able to find, look for price points where the stock price has repeatedly reversed in this direction. Sorry, and resistance is the same. It is a price ceiling. It is a ceiling from which the selling pressure kicks in, making it hard for the price to go higher. Traders also watch this level. This level is where one needs to exit. You will know it from a candlestick. I'll show it to you. Going further. So we finished the second tool also. Now we are going into the third tool. That is the candlestick. You have a red candle, you have a green candle. In some charts, you will see a black and a white. A red, a green, and you can change the color on your charts. You can do it. Charts can be visible on investing.com, tradingview.com, chartinc.com, many kind of things. You just need to Google it. You will find, where will you find candlestick formations? Okay, so now a red candle and a green candle. We are going to do only two or three candlestick formations here. The basic is, a red candle means a price is, the candle has opened at a price and then it fell down. The price fell down and day end it closed below. That means it's a red candle. Day end it closed below. It opened at a price. Maybe it went up a little higher, didn't stay there, finally closed at a lower price. So when it opens at a price, but the closing is lower, it's a red candle. Okay. Opens at a price, goes up, closes at a higher price, It's a green candle. Opens at a price, closes at a higher price. It's a green candle. A green candle means a bullish candle. Red candle is a bearish candle. Please note, these are your tools, a green candle and a red candle. The wicks that you can see, these are the upper shadows in which the candle moves. The candle moves, but does not close there, just goes higher. These are the different variations. But what is important is, where does your candle close at the end of the day? Where does it close? If it closes lower, that means it's a bearish candle. Closes higher, it's a bullish candle. These are your three tools. You've got your trends, you've got your support resistance, you've got your candlestick formations. These are your tools. Apply this on a chart. This is a very, very important candle. A very, very important candle. Most effective candlestick pattern. Most effective. It is a hammer. Very simple candle, a hammer. This hammer, this is a candlestick pattern in a chart. If you see that it is after the stock has fallen, the stock has fallen. 2, 3 red candles, 4 red candles, the stock has fallen. This you can see at the bottom of that, after the candles have fallen, you see this. This is going to hammer the bottom, and then your stock is going to go up. It's a very, very effective candlestick pattern. Hammer is one candle pattern that occurs in a downtrend when the bulls make a start to step into the rally. It is so named because it hammers out the bottom. It is an extremely effective candle, one of my favorite candles. I, in fact, trade on this candle. And I tell everybody, whoever I speak to, my husband, my friends, the students who have been with me, is just trade on this. You know the stock has made a bottom. In fact, just somebody here also in Jakarta, we have a group, and I told her and I showed her how to take Apollo tires. She asked me, should I take Apollo tires? The minute I saw the hammer, I said, just get into it. And this, I think the stock has moved 25 rupees in just 2 days, Apollo tires. Hanging man is the same kind of a hammer. It's called a hanging man. Why is it called a hanging man? Because it appears at an uptrend. The stock has gone up. It appears at an uptrend. It is a real body, can be seen black or white, red or green. The color does not matter. Color does not matter. But the same hammer, it signifies a reversal of a potential top reversal. It requires confirmation in the next trading session. The hanging man usually has a little or no upper shadow. The same hammer, if you see in an uptrend, means the stock has gone up, and you see it on top. That means it's going to hammer the top, or it's going to fall down now. The most effective candlestick pattern. Hammer when it is at a downtrend, and it is called hanging man when it is at an uptrend. Means it will hammer the top and the stock is going to fall. It is great. It is extremely exciting. You will love it when you see it on the charts. Now we have a bullish engulfing and a bearish engulfing. Bullish engulfing pattern consists of a large green candle, real body candle that engulfs a small red candle during a downtrend. It signifies that there are more buyers than sellers. It's very simple, okay? Now, the bullish candle is bigger than the bearish candle. It engulfs the bearish candle. The bullish candle is bigger than the bearish. So what will it be? What sign can it be? Logic, common sense. It's a bullish sign, right? When the green candle is bigger than the red candle. Here it is that it must engulf the total. Means even the bottom, it should engulf the entire bottom and the top, if you can see. It's called bullish engulfing. It is a major reversal pattern. This happens in a downtrend. The stocks have fallen, just like you saw the hammer. If you see this bullish engulfing, the green candles engulf the red candle, it will reverse. The trend will reverse. Buy your stock there. Buy your stock there. Okay. Similarly, a bearish engulfing pattern. It occurs when the sellers are overwhelming the buyers, when there are more sellers than the buyers. So if you see this in an uptrend, the stock has gone up, and then you see all of a sudden today a red candle has formed, means it's the price opened on top, closed, and it has engulfed the previous green candle. God, get out. Better to get out. It's a bearish pattern formed at an uptrend. Okay, bearish pattern formed at an uptrend. Now, we have done 3 candlesticks. There are many more candlesticks. There is a book on candlestick patterns, Japanese candlesticks by Steve Nisson. You can study that. You can do courses. You have to study this in depth, but it is so exciting. And once you know your tools, apply your techniques, you can trade scientifically. You will not lose money. 3 tools, 2 techniques, do it. Now you go to apply it on a chart. Chart is the heart of the market. It is like seeing when you go to a doctor and the doctor sees you say you're not feeling well, he'll make you do an ECG. He will see your health in an ECG. The chart is similar. Somebody tells you a stock, put that stock on a chart and see the ECG of the stock. See the ECG of the stock, you will know how the stock is doing. Even if supposing the stock is bullish, but if the stock is at resistance, you can't buy there. You have to wait for that stock to come to support. Once again, somebody's telling me that this stock is very good. It's a budget stock also, and it's a very good stock. It's a power stock. It's a very good stock, but I have not given a green signal like this because I'm seeing it is at resistance. I just want it to come to support and then tell the person, okay, go ahead, buy the stock. The stock may be good, but you have to buy it at support. It's, oh my God, you recommended the stock to me and look where the stock has gone. It's fallen after I bought. So traders it's a process. Follow the process. Don't think of the profit. Follow a process. You won't go wrong. You see everything on a chart. Charts visually show the historical price movements of stocks. It shows you history. It shows you a monthly chart, weekly chart, daily chart, hourly chart, a stock in minutes. Charts are used to analyze trends, support resistance levels, and patterns. Charts display price data over daily, weekly, and monthly time frames. Technical indicators like which we are going to do just now, RSI, which is also seen on charts. Patterns are seen on charts. Decision making, it's very essential for determining entry and exit points in trading. See your chart. The chart of the stock. It is the ECG of the stock, the health of the stock. Now I've just put this you can see this. This is bearish engulfing. You can see a big red candle has engulfed a green candle. This is after the stock has gone up. It has engulfed the green candle. Look, the stock is falling down after that. Bearish engulfing. Please see it. A big red candle has engulfed a small green candle after the stock has gone up in an upward trend. See, the trend is up. The trend has gone up. It has engulfed it. What happens after that? The stock keeps falling down. See this hammer? You can see this hammer has formed at should I zoom in more? This I'm not able to zoom in more. This hammer has formed at a downtrend. The minute this hammer forms, the stock goes up. The minute this hanging man forms on top, the same kind of a hammer hammering the top, the stock falls down. This is hanging man hammer hammering the bottom, stock goes up. This is all from a chart. I've just screen grabbed it from a chart. And this is hammering the top. So we've done hammer, we've done hanging man, we've done bearish engulfing on a chart. It is extremely effective. You won't go wrong. You won't go wrong. Now we come to technique. We've analyzed all the 3 tools on the chart. Now technique, which stock am I going to do it on? How will I know which stock? There are 4,000 stocks. How am I going to do it? Okay, this is the way you're going to do it, how you're going to do the stock. Now, I'm going to see how the world market is. The world market right now, mostly for India, it's the mother market is the US. The mother market is bullish. It's if you see it on a chart, it's making higher tops and higher bottoms. Nasdaq, S&P, Dow Jones, everything is on top. Similarly, then we come, that's a satellite view. Then we come to a helicopter view. That's India. Now, please note this. India will constitute 40%. What is India doing? It's in a bullish run. It's in a bull run. It's only making higher tops. And we made, yesterday, our Nifty is at highest ever. Highest ever. So it is like it's in its highest ever. It's a bullish run. So don't doubt that run. Don't doubt it. Oh, girega, it's going to fall. What's going to happen? Don't doubt it. Don't doubt it. Till you see a trend change, you will see a trend change when it changes. Right now, we are in upward trend. Don't even doubt it. That constitutes 40% of your probability. Then comes the aerial view. You will see aerial view. What does aerial view means? Which sector am I going to put in? Don't put it. If you're going to put it in banks right now, we are being stupid. Okay. You have to see which sector is performing well. That constitutes 40% of your probability. So 40% is my Nifty, 40% is my sector, 20% now which stock in the sector is going to do well. That's all. That's how we're going to. So this is top-down approach. We are going to see the India market. Then we are going to see which sector in that market. After we identified the sector, we are going to see which stock in that market. Stock price in a chart will tell you the positive news or the negative news of the stock visually. News gives you static information. Price in a chart will tell you, just look at the price. The price will tell you the positive or negative news. You don't need to know news. News is tail news. The price will, market discounts everything. One more line of the Dow theory. That means market discounts everything means everything of your stock is in the market price. You will know that the stock is doing well. Reliance is doing well, or Adani is doing well, or NTPC is doing well. You will know it from the price of the stock. Price in a chart will tell you the positive news or negative news of the stock visually. You see it, you'll know it. News gives you static information. Top-down approach, which is one strategy. At first, we must see the world indices. Nasdaq is all-time high. That's a satellite view. Then comes your own indices. That's Nifty, which is also at all-time high. Helicopter view. Which sectors are performing right well? Right now, aerial view. Put all the sectors. All the sectors are available over there. How many sectors are there? It's available in NSE, on the NSE website. Take out all the sectors: NSE Consumer, NSE Realty, NSE Public Sector Banks, NSE IT, NSE FMCG, and that all these things are there in nsc.com. Go check it out, put them on your charts and see it for yourself, which sector is performing. Which sector has an higher everything. Whatever tools I've taught you applies in everything. Which sector is making a higher top, higher bottom? See it for yourself. Okay. And in this bullish sector, which stock is performing? Trading should be process driven. Focus on the process, not on the profit. If you know your process, you're done. Use a scientific approach in investing and in trading. This I'm giving you a data, best performing sectors in Nifty, 10 years data. This is not for you to make a note or anything like this. What basically I'm trying to show you in this is that basically sectors change. Sectors change. Now, in 2013, IT was the best performing sector. 2014, banks. 2015, pharma. 2016, metal. 2017, realty. 2018, IT. 19, realty. 20, pharma. There is sector rotation. If realty did very well in 2023, doesn't mean you hold on to it in 2024. There is sector rotation. Please see which sector is performing well. That is the only purpose of this data that I have compiled and I'm sharing it with you, is to show you data is king. God is in details. Please get into it. use a scientific approach. You will not go wrong. Even monthly, if you see over here, the sectors are changing even in 2024. You had different in January. In 2024, we had oil and gas. In February, we had PSU Bank. In March, we had auto. April, we had metal. May, we had PSE, public sector enterprise. June, we have IT. July, we have IT. We have pharma. We have FMCG in July. So keep it. Now choose your sectors in July, for example, should have been IT, your pharma, and should have been FMCG. You would have made money. Now you got to identify your stock over there. I'll tell you how to even identify a stock. Now, this is how you're going to identify a stock. This is called the momentum strategy, as we already discussed. The it all moves, stock moves in trends, okay? This RSI is a momentum indicator. It is a speed indicator, speed. As we said, the car moves in speed. You have a speedometer, you can move at a speed of 100, you can move at a speed of 40 to 60, you can move at a speed of 0 to 20. RSI is a momentum indicator which moves only between 0 to 100. This RSI is an indicator available on investing.com, available on tradingview.com, available on charting.com. You have to just go to the tools and in the techniques over there and just click on the RSI will appear. It will appear on the bottom of your chart. And you have to correlate it with your stock price in the candlestick. If you see this stock is going up, you can see the RSI is also above 60. It is between 0 and 100. Let's identify it. You can screen grab this. This is a very important thing. You can screen grab this. Take a picture of this. If a stock is, this RSI will show RSI is between 0 and 100. There used to be a conventional RSI. If you study books, okay, I don't go by this. I don't go by the books in this. I've studied enough, and what I have come to is this is what I'm explaining to you. Just follow this. It will show you between 0 to 70. That's what's going to show you, but let it be 0 to 100. You can change it on the RSI, make it 0 to 100. Please follow this. 0 to 40 means a stock is bearish. If the RSI is showing you that if the RSI is showing you 40 to 60, the stock is sideways. If the RSI is showing you that the stock is between 60 to 100, stock is bullish. When will you enter? When will you be in that stock? You will be in that stock when it is showing you that this RSI, that your stock RSI is between 60 to 100. 40 to 60 is just going to test your patience. Bearish is when you want to short. And imagine entering a stock when it's at its bearish phase. My God, your stock will come to 40, again it will go down, again come to 40, again it will go down. That's when you're going to lose money. This is a secret ingredient, RSI. Just put it on your charts. When RSI is above 60, it generally indicates that the security is in an uptrend and has been experiencing strong buying. This level suggests that the security is relatively strong and may continue to rise in the near term. The minute it moves 60, don't think it's going to turn. No, it will continue there. It can go up to 100. Don't worry. Conventional RSI will tell you that 70, after 70 later, it will come down. No. It can continue to remain there, right up to 100. You find your reversal patterns, find a bearish engulfing on top, find a hanging man on top, and then, till then, just be here. As long as the RSI is above 60, let your stock be here. Don't listen to anybody. This level suggests the security is relatively strong and may continue to rise in the near term. Traders interpret RSI above 60 as a bullish signal, signaling that the security has more room to grow. Downtrend. When the RSI is below 40, it indicates the security is in a downtrend. Imagine somebody tells you to buy a stock and you put it on a chart and you put the RSI and you see, oh my God, RSI is below 40. Am I going to listen to that person? However, the person may be doing insider trading. No, I'm not going to listen. I'm not going to listen. Because this level suggests security is weak and it is continue to decline in the near term. If there is insider trading or whatever, that may get lucky, but you may win once, you will lose 100 times. Follow this. You will lose once in this, but gain 100 times. Traders interpret RSI below 40 as a bearish signal. So this is a downtrend. You will see the RSI is all through. This is a chart that I have screen grabbed. The RSI continues to be, it goes up to 40, again falls down, goes up to 40, again falls down. It's showing that the security has more room to fall till it does a range shift. When it moves from 40 to 60, you buy. When the relative strength is in the range of 40 to 60, the sideways range means it is getting ready for the next move. Look at this. Look at this. Moving between 40 to 60. Look at this moving between 40 to 60. It is getting ready for its move. It's a consolidation. This particular pattern right now is an accumulation, which we've already done. Accumulation of a sideways trend. When a relative strength, you see that this is also moving sideways, 40 to 60, 40 to 60. The minute it moves from 40 to 60, this is a leading indicator. It will move before the candle. Please note, your RSI will move before your candle moves. When you see there is a shift here from 40 to 60, and you get a hammer here at the bottom, go ahead and buy it. You're sorted. You know trading. Isn't it simple? This is it. When the stock is going to be in an uptrend, RSI will be in an uptrend. When it comes down, it is in a downtrend. When you see a hammer, when you see a range shift from here, when it's going up, when you get into the stock, buy. When will you buy? When you see a green candle. See, this particular candle has formed a bullish harami, which the candlestick we haven't studied. It's a Japanese term. And it has formed a hammer. You buy it. What will be your stop loss? Just the low of that candle. Just the low of the candle is your stop loss, and just keep riding your profits. Don't worry. Know these tools, know these techniques, and you will be a winner. You will not lose money in the stock market. And I'll just quickly, the tools and techniques are over. I'll just quickly run you through this. Just keep this in mind. If you want, screen grab it. These are salient points for trading. Trading psychology is crucial. Watch out for emotions like greed, revenge trading, that, oh my God, my stock fell. I'm going to wait. I'm going to wait till it goes up. You're being a trader, you became a long-term investor. Don't do revenge trading. Fear of missing out. Never mind, the stock went up, I missed out. Trading, it's a continuous thing. You're not missing out. Don't worry. Budget has come, election has come. Market is not sleeping. Market never sleeps. You will get an opportunity every day. Study. You're not missing out. Never mind, today this sector is doing well. You missed a sector. No problem. Next month, another sector will come. People have been trading for 20 years, 30 years. I have just started. I'm not missing out on anything. I have just started. It's been 4 years, 2 years I studied, 2 years I've been trading. But yes, I went a lot of depth into it. You do online courses, you keep a mentor, you read books, watch your YouTubes, do all this. You do not have to wait for 2 years. I'm giving you a shortcut. Start trading today. The current stock price reflects future expectations, not past performance. Don't try to predict the market, friends. Don't try to predict the market. Follow the market, follow the trends. Whatever trend it is, just you be in that trend, follow the trend, make your money in the trend. Don't predict, oh, it's going to fall now. Don't. Use stop loss to manage your risk. Identify the dominant force in the market is bullish or bearish. You keep waiting now. Market's already run up so much. You'll keep waiting. Oh, it will fall. See what the dominant force is. Bullish. Ride in the bullish trend. Don't wait for it to fall. You'll keep waiting. And you would have missed the bus in that case. Align your strategies accordingly. But tomorrow, some unforeseen event happens in the world and all the markets turn negative. So the view has changed, and the satellite view, helicopter view, aerial view, everything has changed, and the trend has changed. You have to see that the satellite view, the helicopter view, the aerial view, you also change. You also change accordingly. Focus on the process focus on the process that I have taught you, and not on the profits. Concentrate on what you can control. What you can control. What can you control? You can control your entry. You can control your stop loss. Don't set specific, ride the bullish run. Put your trailing stop loss and ride it. You will do this if you to do a trailing stop loss and all, you will have to do a course. If your reason is trading and if your reason for trading is compelling and strong, trading method becomes manageable as you are motivated and committed to taking the necessary actions to achieving success. Formal education provides a living. Self-education leads to financial success. That's what I have done. Self-education. I have not gone into, there are many Elliott waves, this trend, that trend, Fibonacci, you have stochastics and this, that. I mean, the lots and lots of things that one can get into. But I have just identified 2-3 techniques, a couple of tools, and I have used it. The 5 C's, clarity, cause, confidence, competence, coaching, and community are essential for success. What is my cause? Do I have clarity? Do I have confidence? Competence comes with skill, coaching, and being in the same community is essential for success. Charts are fundamental in understanding the market. Avoid holding on to a specific sector. I have told you repeatedly, as market conditions change. Base your decisions on data rather than speculation. Specialize in few tools rather than trying to learn everything. Focus on following a structured process rather than understanding why is the market going up? Why is the market falling? I don't have to see all that. Replace greed with compassion to make better decisions. Transform your life with disciplined and informed investing strategies. A small, this is the end of the session, just a 30-second video. Just watch it. This is by Rakesh Jhunjhunwala, one of the biggest investors of our times. It's just a 30-second video.
The stock market well, the men must understand women well. Because markets are like women. Always commanding, always mysterious, always absurd. Always volatile, always exciting. And I truly feel that I'm not saying it to make you laugh. Because see, you cannot have a good relationship with a woman by browbeating her, by bullying her. The only way you can have a good relationship with a woman is by accepting her, by following her, by respecting her, by learning from her. And the stock market is exactly like that. If you want to learn the market, see, the process to learn the market is a journey and not a destination. So the process of learning is continuous. But if you want to learn, you have to be humble. If anything goes wrong, you must realize that you have made a mistake. Market has not made a mistake. I think that humility is very, very important to understand markets.
Thank you, Kavita. That was indeed very, very informative. And I really liked your presentation style. It was like you really very passionate about stock trading. And some of the points you made about learning and focusing on a few tools so that you can study those better, looking at all the amount of information out there and learning from it, finding the data and getting the right decision. I think those are all very, very valid points. Even for me, it means I don't do stock trading, but you have inspired me to look at it in a more serious manner
Yes,
and
scientific and
try this
structured
out.
manner.
Yeah. So, we would like to open this session to questions, if any. Please type your questions in the chat box. So there's a question there from my daughter Isha, where she says, when a hanging man appears, is it possible that there'll be another hanging man, or is it always alternating between a hanging man and a hammer?
No, it not necessarily another hanging man will appear. It's just that you have to get another confirmation. So where when it's the hammer, we are confident it's going to go up. But in the top when the market has already gone up and then it forms a hanging man, just wait for the next day's signal. If it forms any other bearish signal, you just short the market,
I
short
see.
it or exit it.
Right. Right.
Short it or exit it.
Okay.
Just
Uh,
wait for that signal.
yeah. So you have to keep watching and you don't have to rush into anything and just
Just
look at it.
one more candle. One more candle means one more time frame. If you're an intraday trader, you will see an hourly time frame. You will see a 15-minute time frame. If
Right.
you are a swing trader or a positional trader, you will see a daily time frame.
Okay. Okay. So I have yet another question in terms of, when we say candlesticks for the first time, I just did not understand what a candlestick was. But after you explained, yes, it became very clear with the chart, etc. So my question is, when you look at the chart, can you further zoom down to into a trend, or looking at when you were saying 0 to 100? Or is there a various level in which you do the 0 to 100? Or can you just zoom down into it?
No, there is an indicator called RSI.
Okay.
In that candlestick, you just have to go on to the functions. It will be FX, the functions. You have to and ask for and just type RSI there. RSI will come on the bottom of the chart. And the
Okay.
RSI you will see is between 30 and 70. That's a conventional RSI, which you have it in investing.com and in trading strategies. You just change on the settings, make it 0 to 100. If you see your stock is above 60, get into it. Don't even
I
think.
see. Okay.
Don't think. If it's 40 to 60, wait for it to move to above 60. And if it is between below 40, don't even, because even if it makes a little rise, it will be a sell on rise. The sellers are waiting there to short it again. It will fall again. Don't enter the stock between 20 and 40.
Right.
It's a bearish trend.
It's fabulous. I would also like to check that, there's so many tools available online. There are also places where you can practice virtually. There are virtual stock markets, etc. Do you think that's a good place to start?
Yes, you study charts on TradingView and investing.com, charting.com. These are the three things you keep watching charts. Like I watch 100 charts a day. I won't tell you, okay, do that because I got too passionate about it. You watch 10 charts a day, watch it. You will understand a bearish candle, a bullish candle. You will understand the support and resistance. You will probably need a coach, a mentor to do it if you're not into reading, because some of us are into reading, some of us are better with audio. Some people just listen to a story. So then it's better you get a mentor, you get a coach, or otherwise there are a lot of books. You have a book on candlestick patterns, Japanese candlesticks from Steve Nisson. You can do that.
Okay.
You can do that. You can join then you have other books also. You have a lot of books. You have Edwards Maggie, which is technical analysis. You have a technical analysis book by Martin Pring.
Hmm.
You can read these books, or you can do coaching. I did a real coaching. You can do online coaching, whatever, whichever way, which makes it easier, because there are a lot of people who study to make it simpler. Maybe you can join a coach
Right.
but you have to know the candlesticks. You have to know candlesticks and you have to know chart. As I told you, chart is the heart of the stock. Like the doctor will see your ECG, you will see the ECG of the stock.
Yeah. Very rightly put. There's another question from Palak. She says, how many techniques should we ideally use to take an entry or exit call? And on which
Uh,
time frame chart for a short-term trade?
Yes, for a short-term trade, what do you mean by short-term? If you're an intraday trader, please note down, it will be to enter will be 5 and 15 minutes to enter a stock if you are an intraday trader. And but to see how the stock is doing for an intraday trader also hourly and daily chart. That's the time frame for an intraday. For a positional trader, that is, I'm doing a swing trading, means I will do one swing, that is 3 to 7 days, or maybe 10 days, 15 days. Do your hourly and daily time frame. If you're a positional trader, that means from few weeks to 3 months, you will do hourly, daily, weekly. You will enter on an hourly support and you will see hourly, daily, weekly charts. That's short to medium term. And long term, which are investors, please see only weekly and monthly chart. Good enough for investors. Weekly and monthly chart of what? Of a stock that you want to buy.
So if one is really serious about stock trading and really getting into it, I think it's a good idea to set aside some time or some, a daily or a weekly practice to go through this so that you know what you're doing instead of just jumping into it without actually studying. There's one other question from Sonia, which she says that people with OCI cards who are persons of Indian origin, can they do trading on the India stock market?
Of course, you can do.
So I think we are at the end of our session. Thank you so much for being here.
Thank you.
sharing
Thank
your
you for
knowledge.
calling me. I love my subject, so I am always ready to speak about it. And I'm sure you please get into it. Just please don't speculate. If you're given tips, tips are always welcome. See those tips on your chart.
Yeah.
Yeah.
Yeah. Make your own informed decision. Study
Yeah.
your market, study everything that you can so that you do not lose any money on the stock market.
Yes.
And on that happy note, thank you so much.
Thank
Thank you again,
you.
Kavita. Thank you,
Thank
everybody,
you.
for joining. If you have feedback, please send us a message. You have our numbers. Send us an email and we'll talk to you soon. Thank you, everyone.
Thank you. Thank you. Thank you.